Good morning, hello, and a very warm welcome to our first panel session of the day, the scene setter for this event, and what a team of panelists we have for you. We have two of the biggest global investors represented here. We have the chief of the London Stock Exchange. We have a capital market specialist whose bank is a genuine leader in sustainability finance. And we have a chief global strategist who is also a sitting Conservative member of Parliament. So let's quickly meet them, and why don't we start with you, Sir John?
Well, good morning, everybody. Yes, I'm here for Charles Stanley, and we'll be expressing their views. I look forward to sharing with you our thoughts on markets and investments. I regard myself at Charles Stanley as the chief worrier. What could go wrong? How could those investments be at risk? Happy to give you some thoughts on all of that over the next hour.
Thank you. Julia.
Good morning, everybody. Julia Hoggett. I'm the CEO of the London Stock Exchange. I'm delighted to be back at Global Borrowers. Having been a DCM banker for many years, it was a fundamental part of the schedule of my life for very many years. And it's great to be back in the fold again. So thank you very much for having me.
Thank you. Stephen?
Good morning, everybody. I work for State Street Global Advisors. I have two roles. One is a fixed income role. In the fixed income space, we manage about $1 trillion of assets, so quite a large investor. And then I'm also the UK head of investment, covering equities, fixed income, different active, passive, etc.
Thank you. Thank you, Monica.
Hi, good morning, and thank you for your kind invitation. It's really a pleasure to be here today. I'm the global head of Amundi Research, the asset management company. And what I'm doing is leading the idea generations and the activity with the investment platform in order to deliver profitable investment opportunities.
Thank you. Last but definitely not least, Atul.
Thanks, Toby. Pleasure to be here. I'm Atul Sodhi, Global Head of Debt Capital Markets at Crédit Agricole Corporate and Investment Bank, working with our clients on a global basis, helping them decipher what's happening in the markets and how to access capital markets in the most efficient and dynamic manner. Of course, sustainability is a big part of our story, but beyond sustainability, we also are a strong bank that helps clients on conventional financing needs.
Thank you, Atul. Thanks very much. Well, of course, there's a lot to discuss. We gather here, although remotely, at a time when inflation is now top of people's minds, and we're wondering whether it's cyclical or structural. We're trying to work out which parts of the global economy have changed permanently as a result of the pandemic. We're trying to work out whether the phrase "build back better" actually means anything, or it's just a nice sounding thing to say. And we're also trying to work out what is more expensive, hitting net zero or not hitting it, as well as other things like the true impact of Brexit and rather soberly, whether mankind can cope with another crisis. Now, before we start the discussion, I should add that those of you in the audience can ask questions. In fact, I'd really encourage you to do so. It's a great opportunity to do that. So on your screens, you should see on the side a Q&A box. Please put your questions in there, and we will endeavour to answer them towards the end of the panel. Right, so let's begin the discussion if we can. And Stephen, I wanted to start with you, really, and I mentioned just in that brief introduction how inflation is at the top of people's minds. So I'd like to ask you, first of all, are interest rates, so they're adjusting upwards as the real economy recovers, but surely there's no need for a real revival of inflation, is there, Stephen?
The multi-trillion-dollar question. I think you know, it's incredible. I think a couple of things. One is how sanguine the markets have been to some of the inflation figures that we saw. I mean, clearly in Q1 this year, we saw the bond market react in a way that was kind of forecasting inflation. We saw break-evens go very, very wide in the US in particular. And then when we've actually had the figures, particularly out of like the US, potentially the UK, the market's been quite sanguine. And I think part of that is just that there's so much noise in the data. You know, we're going to use the word unprecedented a lot today, I would imagine, but certainly when it comes to kind of economic modelling, etc., things are extremely difficult to predict. And so I think the market is almost discarding some of that data and really thinking about the longer term. And I think, clearly there is a cyclical upswing in inflation, and when you look at some of the trends in the underlying components of inflation, they are concerning. But then there are huge structural issues that remain unsolved. I mean, the level of debt that we're going to come out of being one. So I think our view on inflation is that there's going to be a strong cyclical upswing. No surprises there. We're seeing that already. But we don't think that longer term we're going to kind of enter a new paradigm. Now that could change, and I think some of the themes that we're going to talk about are structural themes today. So, for example, the building back in a kind of greener way has the potential to be more inflationary, and also things like infrastructure spending and multilateralism around that have the potential to raise longer term growth. So I think if you think about interest rates, those are the sorts of structural themes that could offset some of the other ones that are there, such as demographics, such as debt. So I think the inflation picture is manageable and calm for now. We don't expect that to kind of move into a new paradigm, but there certainly are some big structural issues which could potentially shift interest rates higher. The last thing I'd say is that just that we're going to talk a lot about policy and what central banks and governments have done, which I would say is the right thing. They've been very interventionist. They've managed to get certainly something like a V in the economic recovery, which was always the aim. But tiptoeing out of that is going to be a real challenge, and that's going to be a balancing act, which is going to be hugely impactful for markets. And we're starting to see signs of that potentially in the US at the moment, where it looks like the Fed are preparing the markets, or about starting to prepare the markets for kind of post-crisis mode.
Thank you. So I can take it that I think you're saying it's cyclical at this stage, and you're perhaps leaving an option to changing your mind in about a year's time. Sorry, excuse me, Monica. How about you? Would you agree with that it's cyclical? We don't need to be worried too much.
I think that we really need to identify the time horizon. So when it goes to 2021, definitely inflation is moving towards an higher regime, which means inflation to stay above 3.5%, right? Then moving into 2022, 2023, we think that it is going to abate, but again, to remain in the 2.5 plus area, and this is because of the factors that Steve was mentioning. The demographic, we are having the millennials that is going to prove a much bigger cohort than the baby boomers that will turning into their 30s, 40s, which means they're gonna create families and they're going to consume. This is inflationary per se. Then we have, this is more short term, but is going to last over the next 2 years, the supply bottlenecks and the reopenings that will be progressive. But we think that some bottlenecks are going there, are staying, will stay there. And then obviously there is this debt that has been piling up that will be a challenge for the governments, and inflation is an easy way out. So to us, it is really important to understand where this inflation is coming from. If it's coming from a recovery, this is fine. If it's not, we might worry about that. And as a consequence, I think it is time to start thinking about hedges to be put in place in the portfolios. Gold is obviously a nice have at this stage. Equities, in particular, when inflation remains in the 3% area, 3% down, equity is a good hedge versus inflation, in particular in the value sectors, and some commodities such as base metals, which are strictly related to the green economy transition. It is something that we are taking in consideration as well.
Thank you. Thank you very much. John, let's hear from you, if you don't mind.
Yes, plenty of inflation around, and not surprising because we've just seen the most enormous fiscal and monetary stimuluses from a whole range of countries, led by the Fed and its famous infinity pledge that it would print as many dollars as it took. I look at the world in three different groups. There's a small group, mercifully small, of very badly run countries with very high inflation, the Venezuelas, the Argentinas, the Turkeys. There's then a solid group of better run emerging market economies that seems to be now reaching 4% plus as a fairly general average inflation rate. Some of them have higher problems. India at 6, Brazil at 8, and they're already now into rate rising in places like Brazil and are having to take restraining action because this is a typical inflation with prices, wages, and so forth. And then you've got the advanced economies who believe they're on the Japanese model, and they believe that they can run at 0 interest rates and print as much as it takes and buy as many bonds as it takes. I think if you're Japan, you still can, and I don't see the likelihood of inflation taking off in Japan. I suspect there's a bit of that in the Eurozone because, again, you've got an aging population and a big savings habit, so there's going to be a bit of a blip in inflation, but I buy the line from the central bank that it will be a blip and then the recovery will sort itself out. But I think there's a much bigger battle going on in the Anglo-Saxon economies, particularly the American economy. You've already got inflation at 5%. The Fed so far has kept the markets in line. The markets believe the Fed when the Fed says, oh, just temporary shortages, few problems to sort out, we put in a bit of capacity, and then the inflation rate will come barreling down again. I think they've got to do more, and I think you're going to see them doing more over the summer. I think they're behind the curve on telling us how they're going to get out of quantitative easing, and they had to admit at their last meeting that they can't delay the interest rate rises for another couple of years. So I think that's work in progress if they don't want this inflation to become self-perpetuating.
So when you say do more over the summer, what sort of things do you want them to do more of, or should they?
Well, I think they will have a meeting sometime soon, either the next meeting or the summer review, when they will have to tell us how they're going to stop quantitative easing. There's going to have to be a plan, a taper, a timetable. Bank of England's already done it, and we didn't inject nearly as much liquidity into the system as the Americans did. Don't have anything like the same inflationary pressures the Americans have, but the Bank of England has already said we're cutting back our quantitative easing up to the back end of this year, and then there won't be any more. The Fed haven't said either of those things, so I think they've got to catch up with the Bank of England, the Bank of Canada, and so forth, who have already announced tapering and the effective end.
Yeah. Julia and Atul, anything to add on the inflation discussion? I think most people believe that it's cyclical at the moment. Any differing views on that, or?
No, I look at inflation sort of. I mean, obviously, you can look at it from the demand side or the supply side factors. I strongly believe that if it is going to be recovery driven and demand driven, it's probably the news which will end some of the bad news we've had so far. So it does mean that we would have, if we do have a revival in demand conditions, it would mean that we've put COVID behind us, we put the pandemic behind us. And of course, we will have to then see how modulated the inflation data comes out at the end of it. But I look at it as the silver lining would be that at the end of the day, if we see some inflationary trends coming out of it, it's probably going to be due to some recovery in the economic activity and the fact that we might have put COVID behind us and we would have a new economic cycle on the upside. So I remain cautiously optimistic on that.
Okay. Yeah, Julia, anything to add there?
I think I'd be largely where Monica is and a lot of the panel are. I think there is something I've learned over the years that you can think about central banks setting interest rates, etc., and monetary policy, but the structural changes in the global economy have had, I think, as much of an impact on the interest rate environment we've had over the last 20 years. I observed that for most of my fixed income life, interest rates have only been going really in one direction and then stopped. And therefore, I think understanding how we do build that better, what form of global economy that takes, what structural shifts adapt and take hold as that evolution progresses, is going to be just as critical in understanding the forward-looking inflation picture as thinking about what central banks are doing. And it's the interplay between those two which will be most critical.
Yeah, the subject of central banks is a really fascinating one at the moment, and I'm just wondering, maybe Sir John, with such high debt levels around, just how independent can central banks be? And is this we've heard the word new paradigm used already? Is this part of the future that the concept of independent central banks will no longer exist?
Well, I think one of the good things about the awful pandemic crisis we've been living through is there's been a much more collaborative spirit between central banks and governments. They've both risen to the challenge in the main countries, and they both understood that they have a role to play that has to be mutually reinforcing and complementary. And I think that is very welcome. I've never believed that any country has a truly independent central bank. You have an apparently independent central bank all the time the central bank pleases enough of the people in government and enough of the people being governed. But as soon as the central bank is thought to be getting it wrong or making mistakes, you get an override or a change of rules. Because of course the central bank isn't sovereign. A central bank answers to a sovereign country, or in the case of the European Union, to a treaty-based organization with committees above the central bank who can change the treaties and the rules. And what we see is, in some cases, governments just don't like the fact the central bank is being a bit too austere as they see it, when maybe the central bank's got very good reasons to be austere. So you may get changes of personnel, you may get changes of target being set, you may get changes of guidance. And at any time, a government can legislate, at any time it can change personnel, at any time it can put undue private pressure or public pressure on. I mean, just think of the scrap between Trump and the Fed. Yeah. When Trump was absolutely sure they were being too austere and they were withdrawing too much support and putting interest rates up too much, and he battled them on Twitter so we could all see it. I'm sure this happens all the time in other countries without you being able to see it. And then eventually the Fed gave in because they said, actually, you know what? You don't think this economy is growing fast enough, and maybe we've withdrawn enough support. So there will always be these battles, and I think you need to be realistic when studying central banks, as investors have to do, because they are critical in their decisions, to understand that the right kind of independence, by getting the judgments right, and for example, resisting inflation when the government wants inflation, is a very good thing, and that can sometimes command popular support as well. But the wrong kind of independence just leads to a crisis, or it leads to a change of rules, so the central bank has to lose.
Yeah, thank you. Stephen and Monica, I'm wondering what's your view at the moment? Do we have the right kind of independence in central banks at the moment?
I think it's definitely welcome, the partnership that the central banks and the governments have been putting in place since the pandemic unfortunately started. Actually, this was something that we have been wishing for a long time, since 2007 with the financial crisis, and then again in 2013 with the sovereign crisis. So it's definitely a plus. However, I think that today's central banks are kind of trapped by the market. So it is not independence from the political cycle we're questioning, but it's how the central banks are engaging with the markets that are testing, for example, the Federal Reserve basically every day. So the central banks are really communicating very smoothly, just to avoid the financial instability that might be detrimental in the aftermath of the pandemic. Having said that, when it goes to the ECB, I think that the ECB is not in an easy situation. And the reason relies to the inflation outlook that the member states within the Union are experiencing. Think about the gap between Germany, for example, and Italy when it goes to the inflation prints, and the need of the ECB for the peripheral countries. So I think that I fear that at some stage the ECB might feel the political pressure out of the Nordic countries or Germany, just because their situation is deeply different from the one of the other state members. So Markets are today trapping the central banks everywhere. This is a global phenomenon. But the political pressure might become quite overloading the ECB decision in the medium term.
Stephen, yeah, so ECB trapped by markets, I guess. Will that ever change going forward?
I mean, I think
we are now with the debt levels.
Yeah, I mean, I think as I said before, I think central banks are going to have to tread extremely carefully over the next couple of years, and I do think that these regional divergences, which Monica highlighted, are absolutely crucial, because in some way monetary policy is global, particularly when you're talking about, you know, large central banks, because capital flows are global now. So I mean, I think you're seeing some of that in the US at the moment, where, you know, the Fed is, I would agree with John. I think the Fed is going to have to start to kind of remove some of the liquidity they have in the system. When you look at the sheer amount of liquidity that's still there, and the emergency financing, I think that's going to have to be removed and signaled soon. But when you look at Europe, they're in a very, very different position, and we obviously talked about Japan as well. And what that means is that these capital flows will influence interest rates in these different countries. So I think, I think the collaboration between governments and central banks has been good. And I would also add to that market participants. I think last March and April, everybody was in crisis mode, and there really was a can-do attitude across stakeholders in the markets. And now, when you move out of crisis mode, and I know we're going to talk about lots of structural things that need solving, the question is, can you keep some of that kind of spirit and can-do attitude? Because we're not out of this yet, and the debt levels are still very high. The central banks have a kind of tightrope to walk, to kind of not appease markets. I don't think they should appease markets, but at the same time, I think we saw with the taper tantrum many years back how very sudden, unexpected changes in direction can lead to some quite serious consequences for markets.
Thank you. Julia, let's hear from you.
I was going to pick up on one of Stephen's comments, and I think, having been a regulator at the height of this crisis when I was at the Financial Conduct Authority before I came to the LSE, one of the things I observed in human nature is the power of the fierce urgency of now. The level of global collaboration that was brought together in very short order was really quite transformative. But actually, when that urgency is felt differently in different areas, and arguably you could say that some of the issues that Monica and Stephen have brought up about the past were a differential sense of the fierce urgency of now in different jurisdictions. We are going to see that fragmentation, I think, as economies recover. And therefore, we are going to, I think there is the risk, almost on a human nature basis, of losing some of that impetus. But that collaboration and the power that it's had and the impact that it's had, I hope is not lost, because it has been incredibly powerful in transforming the way that markets have functioned. And if we can keep some kernel of that, I think it would be incredibly valuable. But I recognise that there are much more structural challenges to keeping it now, as we come out of this crisis, one hopes, compared to the creation of that at the height of it.
Thank you. Sir John.
Just wanted to come in on the rather different situation with the ECB and the euro, because of course you don't have a single government and a single sovereign. And as we've been hearing, the Germans are often in disagreement because they don't want it to become a transfer union. They don't want the ECB's very good work intermediating between the German surplus and the Italian and the Spanish deficits becoming a permanent transfer of German money. But I just wanted to make a few points on that. The first is Germany is not on her own. There are other Nordics who are on the austere line, who don't believe it should be a transfer union. It shouldn't become a proper country with shared welfare policies and taxes on the rich in the successful countries passing directly to the poor in the less successful countries. But we're also seeing probably Germany on the move, because we look as if we're about to see the end of the Merkel era. It looks as if there's going to be quite a complex coalition in Germany because of the weak polling position of all the major parties. But at least temporarily, the CDU-CSU seems to be the top of the minorities at the moment, which implies one does need to learn more about Mr. Laschet. And he seems to be an integrationist. So I think watch this space, because at some point, the obvious difference between the euro and the other countries will become very clear, that the ECB has bought in lots of Italian, Spanish, Greek debt. But that's not the same as the Fed buying in lots of American debt, because the Fed and America and the American government are the same thing, whereas the ECB is not the same thing as the government and people of Italy or the government and people of Spain. And so the Spanish or the Italian government still have a very real debt, even though it's been bought in by their central bank, in a way which the debt is not so real if you're in a unitary state. And I think that's going to be a distinction that comes to matter quite a lot.
Okay, thank you. So I think quite a few people have mentioned the positive effects of good collaboration, and I think, you know, by and large, I guess that's telling me that you all think that the response to the COVID pandemic has been appropriate. But I'm wondering whether you think that the response that we've seen over the last 12, 15 months is now in fact a benchmark for future crises. So, for example, you know, will we see furlough unfurled every time something catastrophic happens to the economy? So, John, back to you on that.
Well, I think it's too early to come to any conclusions about the overall response of different governments to the pandemic. And I think you have to start with the medical response and then the controls and how appropriate they were. And I think there still needs to be a lot of number crunching and research into what was the best way of curbing the transmission and lowering the death rate, because there are no obvious correlations at the moment between particular policies and success or failure. I think the narrower question of the economic response, I think there's much more agreement about that. I think people right, left and centre and people in most countries agree that once the decision had been taken by any given government that they were going to lock down maybe a quarter of the economy and prevent it trading at all and make it more difficult for the rest of the economy to trade, you needed a very big offset to that. And that's perfectly good basic economics, that if you dry up all those sources of income and activity, you need to provide substitutes. So I think furlough or employment support schemes were very widely adopted and were very sensible, and they cushioned the blow, and providing a lot of liquidity prevented an asset price meltdown. We were very close to the pandemic crisis transmuting into a banking crisis in March of 2020, and then the Infinity Fed came to the rescue, and that was obviously a very timely and huge response, which saved us from something far worse, the imposition of a 2008 type financial crisis on top of what was already a pretty severe health crisis. So I think the people doing the economic policy probably get an easier ride in the inquiry. I think it's going to be much more difficult to work out what was the right health response and what was the right degree of lockdown response in handling an unpleasant illness.
But I think to my second question, which was, you know, will future crises have to be dealt with in the same way, i.e., there'll be presumably political pressure to bring in the same support measures next time around?
I hope every crisis is different, and I think it'd be quite wrong to say we're going to do the same thing next time around. I hope we will learn, and I hope we will have learned from the medical and pandemic control were we to have another disease crisis, but it's very likely, as a persistent worrier, that the next crisis will be about something completely different. And that maybe we should be worrying now about the aftermath of all this, and how many zombie companies and how fast is the transition going to be on decarbonisation, because there are going to be lots of stresses from those issues, which will need very careful management.
Yes, so Atul, you've got Atul first, and then we'll hear from Stephen. Yeah, thank you.
So I'll just sort of comment on two parts of the crisis and how we've responded very well, and how it actually gives us a playbook for things to happen in the future. So on the one hand, if you look at the economic response and the governmental response, it's been far beyond what one would have thought if one turns back the clock 2 years and says, if this would happen, would the government respond in this way, and would they have got so well coordinated? I think 2 years back, we would not have put our money on the fact that it would turn out this way and they would do such a good job of responding to it. Now, of course, the challenge is to come out of this in the right way and deal with the aftermath, but that's another playbook that will play out. But the other part, if you talk to the medical community, is also very heartening to see. And as Sir John said, no two crises are the same. Who knows what is the next medical crisis? We may have another kind of virus tomorrow or something else. The medical community has done unprecedented level of coordination in their research. You know, the amount of, if you talk to the researching community, the thousands of papers that have been put out in the public space and the information that has been shared by researchers is what has allowed the world to come out with so many vaccines for a population of 7 billion in the world, and a lot of them getting vaccinated every day. That is what is also very heartening to see, that beyond the government, there is also the private response, which could be done in a very well coordinated manner, thanks to technology to some extent. But that's what is, to me, a very important silver lining in this whole story.
Thank you. Stephen?
Yeah, I just wanted to make the point. I think, I think John was touching on this, but it's almost certain that the next sudden shock will not be predictable. I mean, by definition, things that are a shock are not something that you were expecting. And so I think really there'll be a lot of focus on the lessons learned from this. And part of that is some of the collaboration we talked about. I think that is something that hopefully, people's, that can be imprinted on memories of regulators, of governments, of other market participants, and that that coming together can happen again. But I also think there's going to be a big focus on resiliency, and that has all sorts of implications. I mean, and it's in all of the key sectors that society relies on, whether it's healthcare, whether it's food, whether it's financial system, and I think some good work has been done since the financial crisis, quite frankly, in the financial system, really making it more resilient. And of course, there's always more to do there. But I think, it's definitely not lost on me. If we'd have gone into this crisis as we did into 07, 08, I think it would have been a very different outcome. And then, I think there's something to be learned in other sectors from this crisis, which was a broad crisis, not just the financial one. And that has all sorts of implications, because to achieve that resiliency, you could say, have we seen peak globalization? Will we see supply chains being onshored? There's all sorts of kind of things that people need to consider about that, and there is some inflationary aspect to that as well. So I think I think that's something that there should and will be focused on over coming years.
Thank you. So John, you got your hand up very quickly from you, if you don't mind.
Yeah, quickly. I think the real study needs to be on how do we get death rates down. And we've had lots of sloppy reporting. We hear that America's had a lot of deaths and Brazil's had a lot of deaths, but the EU has actually had more deaths than either of those. But what matters is the death rate in relation to the size of the population. So we need studies of why it is that Czechia and Hungary have had much higher death rate than many other countries. Why has Belgium had the worst of the death rates in advanced Europe in the West? Why have some of the Asian countries had very low death rates? What have they been doing right? Or is there something else that's going on there? So I think that's the study we need in order to better equip us should we get another pandemic.
Thank you.
If I can add
Yes,
sorry,
please,
Toby.
please,
If I can add a comment, I would distinguish between phase 1 and phase 2 of the crisis and the responses that we had. In phase 1, it was a matter of implementing a recovery. And here we've seen all the coordination and agreement that the Next Generation Fund, for example, has been one of the major steps forward in the European Union. But then we are turning into phase 2. We are talking about boosting the economy. We are talking about implementation of all the investment plans that are in the cards. And this is a far more challenging phase that will open up eventually the case for debt sustainability and higher rates amid higher growth. So while in the phase one, I would really eventually mark 8, if you allow me to give a score 1 to 10. In the implementation phase, this is still an open debate. We really need to see how capable and successful we will be in implementing those strategies that will allow the productivity increase that we need to address a more sustainable growth in the medium to long term.
Thank you. So John mentioned actually the word, zombie companies. And I think, so far in the developed world, the level of corporate failures and defaults as a result of COVID have been much less bad than feared. But, do we think that support measures has just created another layer of zombie companies? And Atul, before you were head of DCM, you were head of corporate DCM. You're probably well positioned to have a view on this, aren't you?
Sure, absolutely. So this is a topic we discuss a lot within the bank, and this is a topic that that the jury is out on it. But the way I look at it is that this crisis will give us winners and losers within sectors, and there will be some sectors, let's say at a big picture level, there will be some sectors which will be winners and losers as well. And that will fuel some consolidation in terms of how industries are organized. And the winners and losers there'll be some M&A activity that'll come out of it. So to some extent, yes, in theory, possibly there are a few more zombie companies, but I would say the flip side of it is there is a chance that the winners will take over the zombies in a way and will come out as a stronger corporate in that sense. And I think even in the sectors, we will see some sectors that will come out stronger at the end of this crisis, and there are some sectors that will be more zombie-like sectors at the end of this crisis. But it is at the end of the day going to be. I don't see it becoming a debt crisis. I don't see it becoming a situation that'll snowball. I feel it'll give us fuel for consolidation in some industries.
So give me some examples of what companies you're talking about that will be winners, or sectors will be winners. You're saying that the Amazons of this world are going to be taking over the American Airlines of this world. But what are we talking about here at all?
No, I think it's possible that as they say, the biggest hotel chain in the world does not own a single room. As they say, Airbnb is the largest hotel chain in the world, but does not own a single hotel room. So these are the kind of business models that will come up, and that's what will happen. In a way, Amazon is the same thing. They don't have a single shop, but they're the largest retailer in the world. So in that sense, the whole business model of the retailing industry, the hotel industry, will transform, and some of the more nimble players in these industries will transform. And that's really how I see it happening.
Yeah, Julia, let's hear from you.
Yeah, I'd make several points. One is, I think we're already seeing some of that transition. So 50% of all of the capital raised on the London Stock Exchange this year has been for technology companies. The third largest segment, and only just third, is those that contribute to the green economy mark. So that illustrates the evolution already of the nature of how companies are transitioning. I also think we need to remember and take a lesson from the 2008 crisis as well. We can think of these as debt solutions, or we can think of these as financing solutions that also include equity. And I think if you look at the way the sort of US versus European response to the financial crisis and the degree of equity that was used in the US, for example, and the pace with which that recovery could then be supported, I think we need to recognize that we need both of those to work for it to work. But I wouldn't underestimate the remarkable power of what happened last year to support companies to be able to get through that transition. The volume of follow-on capital that was raised very quickly, that supported companies, enabled them to continue to function, was a fundamental part of helping them survive and be able to then be in the position, as Atul says, to take advantage of the opportunities that present themselves. And but we are in a tale of two halves. I think about the degree to which the financial services industry transitioned so quickly to remote working, transitioned to continuing to be able to transact, to undertake, to do deals, to raise kind of phenomenal volumes of debt financing. We're doing virtual IPOs every day, things that we'd never thought were possible. And that fierce urgency of now has evolved how the capital markets function. Those economies that don't have that, those parts of the economy that don't have that ability to adapt, are going to have to find either new forms of delivering their service, or they are going to struggle, I think, compared to those that have an easier way of adapting. And that is, but we're already seeing that in the way companies are coming to market and in where investors are placing their money.
Thank you, Julia. You raised a few points there, which I think we'll get onto hopefully towards the end of the panel there, including remote working and things. But I just, we have a new man in the White House this year, and I think we need to discuss that a bit. So let's start with Monica and Stephen for this question. But what does the Biden era mean for bonds? Monica, if I can hear from you first on that.
Well, the Biden era with a 1.9 trillion package plus a 4 trillion package implies hopefully more growth, definitely more taxes, and eventually more debt. So it is not really a rosy situation for the bondholders. But as long as rates are going to move higher, as we do expect for the US Treasury in 12 months, we expect the rate to be around 2.3, 2.1. So definitely rates on the higher. Whether this is grounded on improving growth, this is positive. So we are going to shift again from the low rates regime into something higher, but it won't be detrimental for the financial market as long as this is coming from better growth. And Biden means investment in the green economy, in infrastructure, in transportation, which usually plays out as efficient investments, meaning increasing productivity and growth. And this is again positive. On the taxation, we might have more fiscal revenues, and this might be positive for bondholders. But I think that we really need to make up our mind and start thinking about higher rates in the future, which implies diversifying different our portfolios and starting to allocate money into high yielders, meaning the emerging market, and likely real estate, because inflation might come into play.
Thank you. Thank you very much. Stephen, how about you?
Yes, I think there's a few points. I mean, the first is how much can Biden achieve in the time that he has? Obviously, he's made an extremely rapid start. I think you would think in terms of just the sheer speed with which his administration has been moving, and in a very simplistic way, obviously, the fiscal stimulus packages and the potential for higher growth have kind of led to steeper yield curves in the States. I do think though his multilateralism is something which is extremely crucial, and that does actually matter to bond markets too. I think when you look at tax reform and you look at you look at debt levels globally, something is going to have to change with tax in order to kind of actually pay this back. I mean, inflation can do some of the work, maybe, but we've been on a march to higher debt levels in sovereign countries for a very long time now, and post pandemic, that's going to have to be dealt with at some level. So I think multilateralism, tax reform could be things that could be positive for bondholders in the longer term. But clearly the fiscal stimulus is all eyes are on that. And then the final thing I'd say is just in terms of infrastructure spending, if infrastructure spending is done well, that does have the potential to raise the longer term growth rates. And if that were to happen, then I think, as Monica was saying, then you'd have to think about interest rates and bond yields going higher.
Sort of similar question, but to you, Sir John. It's really, you know, what does the Biden era mean for global trade and alliances?
Well, the Biden presidency clearly means very good news for bond traders, because there are going to be a lot more bonds to trade. But it also means higher interest rates, higher inflation, higher borrowing, higher public spending. That's all part of the package, some good, some bad. And let's hope we get a good recovery out of it. It's clearly helping fuel a global recovery, which was initiated under the predecessor and the Fed, and the present government has quite a lot of continuity of policy, although they don't see it like that with Trump, who wasn't shy about borrowing a lot and spending quite a bit as well. But we're going to have even more of that with a Biden presidency. And Biden has made a big pitch to say that he wishes America to collaborate and work very closely with a series of allies around the world, and he used the G7 very effectively to project the kind of politics he believes in. And I think what has come as a surprise to some people is that whilst the politics is attempting to be more inclusive with the European allies and with Australia and New Zealand and Canada and so forth, the alliance of the democracies, if anything, he's tougher than Trump on China and on Russia, and sees those as hostile forces in the world. So he is reinforcing a movement that was already there under Trump towards a great digital divide. You can feel a great digital iron curtain coming down and being strengthened between a Chinese-led system and an American-led system. And I think the other thing you should expect from Biden is that whilst he sounds very moderate and he's very friendly, he intends to lead this democratic grouping, and he's trying to get the Europeans into line over the more hostile attitude towards China, the worries over dependence on Russian gas, the dislike of Nord Stream 2, the wish to see Europe more fully aligned with America and less aligned more globally, because I think the EU was hoping to do a Chinese trade deal. That's looking a bit more difficult with Biden producing the kind of influence he's producing. So I think we're going to see a much clearer divided world with Biden, with a democratic grouping on the one side and the communist or autocratic states on the other side. And then you're going to see policies of national and democratic resilience. So I think there's a massive move into getting more of the key technologies under Western control and having more domestic capacity. I mean, starting with semiconductors, obviously, where there's a panic to get enough semiconductor production into the United States of America itself at a time of major shortage.
Thank you. Atul, did you have your hand up? Yeah, let's just hear.
Yeah, I just had a quick comment to make on what Biden has done in terms of putting a topic front and center in terms of the markets, is the topic of sustainability and climate change. As we know, the previous regime was sort of not really buying that story, but Biden has clearly put that front and center. So what that has meant is the large US asset managers are also now sort of on the same path. Large US issuers are talking the same story. As we know, the whole sustainability, sustainable finance movement has its origins in Europe in many ways, and Europe has led the way. Now we are seeing a lot more coming from the other side of the pond, and I think this is going to accelerate the sustainable finance movement and make it more mainstream.
Yeah. Okay. Well, that brings us on to one of my questions, which is around net zero by 2050. You know, can we afford it, really? And the flip side to that question is, can we afford not to hit it? Julia, how about you?
I'd be in the latter camp, in that I think we have no choice, and I think if one looks at increasing amounts of the data, the potential economic impact of climate change is something that cannot be underestimated and does need to be taken into direct account. That first urgency of now problem is absolutely one of the challenges of how you get people to coalesce around the risk profile of this. But I think one of the things that the Biden transition has also done is, I think, potentially changed what the aspirations for COP26 can be.
Okay.
I think from one that was very understandably focused on coalescing around private market solutions and the evolution of the private markets for ESG. I think that is absolutely something that needs to be done, and that focus has been incredibly valuable in developing the priorities for the next few years. But the public response aligned to that, which I think has probably got a lot more impetus as a consequence, I think will potentially make COP very powerful. The key thing for us as a venue is, and for me personally, is how we think about not thinking about sustainability bonds and transition bonds and green bonds and green economy marks as peripheral to how we think about how markets function, but increasingly essential to how we think about how they function. If we are genuinely going to get to net zero, then we have to bake this stuff in to how we think about disclosures and how we understand the value of assets going forwards. And I think my phrase that I use internally is how we think of ESG as BAU. And I think of it absolutely fundamentally through the lens of what is done on the fixed income markets, but we think about it as a whole venue solution. And one of the things that is absolutely critical in that is actually discipline. It is making sure that we have the right data to support the right understanding of the impact of each project and the impact of any investment on the transition to net zero, and making sure that actually we're disciplined about making sure that a green bond is genuinely a green bond, that we understand and map the transition, and that we understand and disclose those standards and investors can understand them as well. Because we have 1 decade shot at getting the momentum that we need for this. If we're still having a conversation about this being on the periphery of our markets in 2030, then I don't actually want to think about the consequences of that. So we do have to use the momentum out of COP, I think.
Just Monica, presumably ESG as BAU, that's presumably how Amundi has been thinking about things for a long time, though, isn't it?
Yes, yes, indeed. I wanted to touch base on what Julia was mentioning, and definitely we have no option on that front, but the industry is moving. I'm thinking about the alliances, those across-the-board groups that has been forming the Net Zero Asset Management Alliance that encounters, for example, 87 asset managers worth 37,000 billion asset under management, and obviously Amundi is part to that alliance, and we are organizing in terms of means and outcome, which means, for example, targeting a certain percentage of net zero corporate in our allocation, informing the clients on the analytics and the step forward into this direction. So I think that materially there are some tangible steps that we are doing. Maybe we should move faster, but this kind of organizations are taking places across the banking sector. There is the Net Zero Banking Alliance, for example, that is taking into account 45 banks, 27 billion assets gathered, or the Net Zero Asset Owners that is taking into account 41 investors. So as you can see, the industry is moving into that direction. Also, when I look into the products that are now on the shelf, we have been moving beyond the ESG as a whole concept, going even more thematic. So targeting the ESG as a whole concept.
Monica, I'm just going to stop you. Sorry, Monica.
So targeting the E, the S, and the G, which is again. Can you hear me?
Monica,
we needed to improve the digitalization, which is a part of the smart working policy and these digital events. So again, to me, it is really important that we are moving into the thematics of the ESG, being even more focused on that front.
Thank you. Stephen, very quickly from you, Julia said we've got a 1 decade shot at this. You guys aren't moving fast enough, are you?
Well, I think when you look at, the for instance, you take climate change, you look at the climate pathways that need to be hit in order to achieve the scenarios that need to be achieved. It's staggering what needs to be done in the next 10 years, 20 years. So there isn't, there's no time to waste. There's absolutely no disagreement on that point. And there's some stats in terms of how you compare like the energy or also the carbon emission reduction from COVID and how you stack that up in terms of what needs to be done on climate change. And it's clear that it's like having a COVID every year or two is the sort of challenge that we're facing. So I think
that doesn't sound realistic, does it?
Well, so I think what it requires is a complete re-engineering of the economic model, and that's policymakers, and you're starting to see some of that. And I would agree that COP26 is going to be an absolutely monumentous occasion, and we all have to hope that goes well. And then on the financial side, I think you are seeing these. I think one of the issues that we've had with ESG investing historically has been, everybody's got their own definition. People are doing things in different ways, and if you're a company trying to make sense of what you need to do to appease your investors, for example, if everybody's doing things in different ways, how do you kind of process that and how do you act on it? But that is changing. I think Monica mentioned net zero. That's part of it. I mean, there's organizations like the Climate Bond Initiative, which I think do some really good work across the industry in terms of green bond standards, sustainability standards. There's also organizations like SASB, which we've been working very, very closely with in terms of standardizing the way that we look at ESG and then holding companies accountable for the way that their ESG profiles look. So I think we all need to do more. And I would agree with Julia that there is absolutely no time to waste. And when you just, when you look at the modeling, it's just, it's a serious undertaking.
Yeah. So we've got about a minute left, everyone. So I'm going to maybe ask you all the same question, if you don't mind, to finish up, which is, if you were running a major financial institution, what would your return to work policy be? So John, very quickly, if I can ask you to answer that question.
I think employers have to consult, but also explain the importance of being in the office for some of the collaborative working and encourage people in that direction.
Thank you. Julia, what about you? Everybody back in or total flexibility?
I think we are moving to a version of a hybrid world in general, but I'd agree with Sir John that actually some of it's about what you want to use the office for. I think of it as the 4 C's of coaching, collaboration, community, and culture.
Look, we've got literally running out of time, so we are going to be cut off. So I'd just like to thank you all very, very much indeed for being with me this morning, and I'd like to thank our audience too. So thank you so much, everyone. I'm sorry we run out of time, but I think that shows time flies when we're having fun. So thanks so much, and thank you to the audience. Thank you. Bye-bye.
Thank you. Bye.